Thank you for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we are following out of the BNN Bloomberg newsroom. The White House says the U.S. President Donald Trump and the Chinese leader Xi Jinping agree that the Strait of Hormuz should remain a free waterway. Both leaders also agree Iran should not be able to exact payments for the use of shipping lanes. Trump called his meeting with Xi positive and productive and is seeking help from the Chinese leader to end the Middle East conflict. Shares of Canadian Tire in the red after the retailer posted second quarter results that came in weaker than expected. Softer consumer spending weighed on overall sales, resulting in revenue and profit missing analyst expectations. Same-store sales also saw a decline. Canadian Tire says sales growth at Sports Chek and Mark's helped to offset the weakness at its flagship Canadian Tire division. Shares of Canada Goose under pressure in today's trading. The Parker Maker reported profit in its most recent quarter that missed Bay Street expectations and says it expects low single-digit revenue growth for its 2027 financial year as it continues navigating a challenging retail environment. On the upside, sales did top estimates, while wholesale revenue surged 54% over the previous year. The TSX up 220 points on the day to 34,261, a move today of 0.7%. South of the border, they are also in the green. The S&P 500 gaining another 61 points or 0.8%. The Dow Jones, a 382-point move above 50,000 to 50,077. And the Nasdaq up another 257 points today, almost a full percent. The Prime Minister, Mark Carney, released a strategy today that aims to double Canada's electricity generation by 2050. For more, let's go to Bloomberg's Ottawa Bureau Chief, Laura Dillon-Kane. She joins us now. Laura, what did the PM say is the objective here? Is this modernizing of the grid?
I think the goals are threefold. So one is to, yes, modernize the grid, make it more efficient, and to sort of reduce our emissions. Like, that's the top line goal. Mark Carney has weakened a lot of the environmental policies that Justin Trudeau brought in, and he does remain committed to reaching net zero by 2050. So he needs to have policies in place to do that. So this is one of them: doubling the electricity grid, getting more Canadians using more renewable forms of energy, less fossil fuels, and improving the environment. He also said that it will help with affordability. As Canadians switch off of fossil fuels and onto things like heat pumps, he does expect that to improve the cost of heating your home. And then finally, it is, he says, to make Canada more competitive economically, to attract more projects with cheaper electricity costs. That is a huge way to draw more investment in. I do think a really important context, though, for the announcement is tomorrow's agreement that is going to be announced with Alberta on the industrial carbon price. A key part of their MOU that they signed back in November was to suspend the clean electricity regulations pending that agreement. So now that they've reached one, the clean electricity regulations will no longer apply in Alberta. And that means the rest of the country needs to have some consultations on what those regulations look like for them. So that was a key part of the announcement today, is that he will begin consultations with provinces, territories, and utilities on what the future for electricity regulation looks like in Canada.
All right. So you mentioned this should save Canadians some money down the line. Was there an estimate of who will save how much?
Yes, he did say that he expects 7 in 10 Canadian households to pay less for energy once the build-out is done, saving them about $15 billion in the aggregate by 2050. Now, in the short term, I would expect that as the grid is built out, that costs may actually increase for some time, but that's not, that's not entirely clear. And the top line goal, as he put it, is to improve affordability. It will cost about $1 trillion for both sort of the public sector, the private sector, to complete the doubling of the grid by 2050. So there are a lot of details still to be worked out for this policy. Really, today was about announcing that goal of doubling the electricity grid, by 2050, and now the consultations begin on how to actually reach that target.
Okay, but you mentioned it will be a pairing of both private and federal money to do this.
Oh, certainly, yes. An estimate of $1 trillion was provided today, but that was definitely not going to be the cost to the federal books. The idea was that that would be shared across the public sector in both the federal level and the provincial and territorial level, and then private utilities as well.
All right, Bloomberg's Ottawa Bureau Chief Laura Dillon-Kane, thanks for your time. Appreciate it. Up next, a stark warning from the Chinese leader at a summit with the U.S. president. Back in a moment. China's leader says the U.S.-China relationship is the world's most consequential, with the U.S. president in the country there for a summit. Let's start there with Sean King of Park Strategies, former senior advisor for Asia in the U.S. Department of Commerce. Sean, thanks for your time.
Good to be with you.
Is it the world's most consequential relationship?
I don't think so. I think your relationships with your friends and allies are more important than those with your enemies and rivals. You know, for example, in the Cold War in the 1980s, I would say Ronald Reagan's most important relationship was not with Mikhail Gorbachev, but with Margaret Thatcher, Brian Mulroney, and Helmut Kohl close behind. So I think you define yourself by getting your team on the same side and facing the outside. So I think a relationship with, say, Japan is more important than it is with mainland China.
There was also a sterner warning from the Chinese leader about Taiwan, with the U.S., as you know, ready to hand over more weapons to that country. What's your take on the timing of the warning and the nature of it?
Well, sadly, this is the second batch that Trump was supposed to approve since he came into office. But this one is on hold, as he says, so as not to upset the meeting with Xi Jinping. And he said before leaving Washington that he would be discussing the arms sales with Xi Jinping. That is at least a spirit violation of Ronald Reagan's 6 assurances from 1982, where it says we will not discuss arms sales to Taiwan with Beijing. So I am not surprised by what Beijing said. This is standard text from them on Taiwan. What does catch my eye, though, is that they let this statement go out as the two leaders were still meeting. So they're being a little more aggressive than usual. They know Trump is holding up the arms sale, has sort of a disdain for U.S. alliances and entanglements abroad. So they probably want to see how far they can push. So I was not surprised by the content of the message, but I was surprised by the timing.
Do you think it'll change U.S. policy at all?
It could. You know, Trump is already the first president to say that he'll hold up an arms sale for dealing with Xi Jinping. So that's a first that we never thought we'd see. You know, we always assume that presidents may hold back arms sales so as not to provoke Beijing. But he's the first one to say it openly. And we have this distinction. We say that we don't support Taiwan independence, but we also very carefully say that we don't oppose it because we consider Taiwan's status undetermined. Now, that's a nuance that may be lost on President Trump, but if he were to say we oppose Taiwan independence, that would be a major step in Beijing's direction and be very demoralizing for people in Taiwan itself. So I hope not, but you can't rule it out based on the fact that we've already held up the arms sale for this meeting.
On Iran, China says the Strait of Hormuz should be open, but has it promised to do anything concrete to ensure that happens?
No. And, you know, I was watching Trump leave the White House yesterday before he went to Beijing, and he said he may not even talk to Xi Jinping about Iran because he doesn't need his help because we're winning. But then the White House statement said that Xi agrees the Strait of Hormuz should be open and that Iran should not have nukes. It reminds me when China also said North Korea should not have nukes, and look where we are today. I read the Chinese statement word for word, and they don't mention Iran once. All they do is that they say they discuss the Middle East. So mainland China gets 16% of its oil from Iran, so no surprise they want to buy some of ours to make up the shortfall. They would rather not have this conflict going on, but I think they enjoy seeing us distracted over there and trying to get out of something that we created. So, yeah, they'll say that, but I don't see them doing too much right now to help.
Are the Chinese still getting their oil shipments through? They were early on in the conflict. I haven't heard anything since.
I have not heard anything since, and I think that mainland Chinese need for oil is less than it used to be because the economy is slowing down. They do have alternate sources, and perhaps a lot of their oil had already left. I hear a lot of the oil is not yet delayed because there was several months worth already at sea. We probably won't know whose needs oil the most out of Iran for another few weeks yet if this remains unresolved.
What is your take on the tech executives on this trip? The NVIDIA leader just sort of jumps in at the last moment. Apple is there. What is your take on why these tech executives are there, if not to deliver on some kind of agreement?
Right. Listen, a U.S. president, U.S. government, like any government, should always be promoting U.S. Business overseas. But China is just not another market. It's our number one rival and peer competitor in many geostrategic military theaters. And I get very nervous when I see tech execs who answer to shareholders who are interested in profits on a plane to sell goods in a country that they can use against us that doesn't even let its own people vote or jails a million Uyghurs in concentration camps. Now, so far, we've only greenlit NVIDIA's H200 chip for sale in the PRC. It's not the coveted Blackwell, but it gets us one step closer to maybe that happening one day. I don't see why we're selling them anything. Again, Cold War comparisons are not perfect, but could you ever imagine Ronald Reagan telling Texas Instruments or IBM to give the Soviet Union some help and sell them some chips to bring up their computer system? It just doesn't add up. So whenever I see these tech execs trying to make a buck in an authoritarian state like the PRC, it makes me very nervous.
Okay, let's talk about deliverables and whether you expect any by the end of the trip.
Yeah, I expect some Boeing aircraft sales. I expect some announcements maybe on soybeans, beef, some other products, maybe putting aside $30 billion of tariff-free goods to work on in the so-called Board of Trade. But again, all that does is begin to get us back to where we were before Liberation Day. And listen, I don't want to do any business with mainland China in an ideal world. I'd rather focus on our allies like Canada and Japan. But if we try to paint this as a great trade success, it's not, because we're still further behind trade with the PRC than where we were when Trump came back to office. And it's a little distressing to see Trump fawn over Xi Jinping as his great friend when he belittles people like Mark Carney, Keir Starmer, and Friedrich Merz. In 2016, Trump said China's raping the U.S. on trade. In 2023, he demanded compensation, damages from Beijing for the spread of COVID-19. Now he says we're united and together with Beijing, which we're clearly not on so many issues, whether it's Hong Kong, Taiwan, South China Sea. So I don't like to see the love fest, but I guess so long as they're talking, things are better than they're not talking. But I'm very cautious about the whole thing.
Yeah, sometimes the answer shifts depending on the circumstance. We know that. Sean King, thanks for joining us. Appreciate your time.
My pleasure. Thank you.
Coming up next, higher silver prices and production drive record first quarter numbers for Aya Gold and Silver. We'll speak to the company's president in just a moment. Aya Gold and Silver higher today after reporting record first quarter revenue and net income, even though it missed earnings expectations. The results driven by increased silver production. So let's go to Benoit Lassalle's president and CEO of Aya Gold and Silver. Thanks for joining us today.
Thank you for inviting me. Thank you.
Net income up over 600% on silver output. When did you start stepping up your silver production, and do you plan on increasing it?
Yes, so this year, 2026, we have a brand new plant that was built in 2024, and it was commissioned in 2025. So obviously, we're coming into a new year, a new era for Aya, and hence the new plant is working at capacity. So obviously, from Q1 2025 to Q1 2026, there's a major increase in production, and also it's not the same selling price. If you recall, last year at this time, we were selling silver at $30 an ounce, and in Q1 of 2026, we were selling silver at $82 an ounce. So not only did we have an increase in the production profile, but we also have a massive increase in margins. The margin used to be $12 an ounce last year, and right now they're approaching $65 an ounce in Q1 of 2026.
Okay, so you mentioned silver prices surge over the past year, but we know silver is volatile. and they're off what were the highs of 2026 now. So what's your outlook for the coming months? What do you think will drive the price of silver?
Well, the silver is a very strategic commodity. It's now coming through that we need silver in AI, we need silver in armament, we need silver in solar panel, we need silver in medical devices, and all of that was not well understood as there was, a lot of inventory. There's never any pressure on the inventory or on the supply, and the demand was there. The demand has been exceeding the supply for the past 5 years. But because of the inventory, people did not see it or mention it. But now we're in a definite squeeze. It's clearly there. Silver is trading right now between 80 and 85. We saw it yesterday. I thought it was going to break 90. But no, the expectation for silver for 2026, it will pass $100 an ounce, and it will keep growing and going because strategically, with this new armament race and a solar panel, silver is critical.
Is that what you're looking at when you prepare your outlook, about $100 an ounce?
We did our budgeting at $50 an ounce in order to be very conservative. But when we looked at our cash flow, because we're building a second mine right now that's going to cost about 450 million US dollars. And with the current production profile that we have and the current price of silver, that second mine gets paid from retained earnings, from our own cash. And that is quite rare in our industry. So in our planning, we are using spot price $80 silver, but in our budgeting for the year, we were using $50 silver. But again, you do your budgets in November of the previous year, and at that time, silver was 40, 45.
Yeah.
And then it's in January that it ran up to 120, came back down, and now it's coming right back up in the months to come.
Okay, good to know. So you also lowered your operating cash costs in the first quarter. How did you do that? And is it sustainable?
Good question. Very good question. So the cash cost is directly related to your strip ratio, as how many tons you have to move of sterile compared to ore. And in Q1 and in Q2, we are in an area of the open pit where the strip ratio is low. There you see it. So if the strip ratio is low, meaning you have a lot of ore exposed, your costs are lower. But our guidance for the year is more $21 cash cost, which is still exceptional. But in Q1, we were at $18 cash cost, which is directly related to a lower strip ratio than the average strip of the for the year.
Okay. You also had some weather-related disruptions at one of your silver mines in Morocco. Can you tell me how that impacted production?
Well, yes. So, we are at 2,200 meters above sea level. We're in the mountain where around us, the peaks are up to 4,000 meters. So when it rains or if it snows, I mean, you get a lot of water and a lot of snow. And then the conveyors don't move as fast. The ore is wet. So you do lose efficiency at the plant. The mine can still run. The open pit has to shut down sometimes, but the underground mine can still run. And but the plant slows down quite a bit. We lost about 300 ton average per day because when we looked at the average processing in Q4 of last year, it was above 3,800, and this time in Q1 it's a little bit below, or it's 3,600. So we lost on average 200 ton a day and per hour, and that makes a difference. So it's normal. We always know that in Q1 because look, we're 2,200 meter above sea level in a corridor of wind and storms. So it's normal. It's like that every year. Some financial analysts were a little bit disappointed with the production number because it was not our guidance divided by 4 for each quarter, because we knew that. But look, we reconfirmed guidance for the year, which for me, that's what's really important, is we knew and we know that every year Q1 is a bit more difficult.
Okay, so you are in Morocco, where you have been for some time. Are you exploring any locations outside of Morocco?
No, we believe, and I strongly believe that Morocco right now in the world is the best jurisdiction. It's got phenomenal geology. It has rare discoveries like our second mine, the Boumadine mine, and it has other discoveries that are world class. The permitting process is very efficient and very quick. Lots of trained employees. And in the world of mining right now, permitting is key. Employees are key. And in Morocco, we meet all the criteria for a tier 1 jurisdiction. So we are staying in Morocco. We are growing our footprint, though. We currently have a footprint of about 1,400 square kilometers, and we are growing our footprint. So as we buy as many licenses as possible or apply with the government to grow our footprint, because it's a little bit like buying real estate on Fifth Avenue when people are not looking to buy real estate. Well, we are buying everything that's possible.
You listed on the NASDAQ earlier this month. How do you compare it? Are there pros and cons to being listed on the TSX as compared to the NASDAQ?
Well, the NASDAQ has much more volume. So you have many institutions in Europe and in North America that have a limit. If you're only listed on TSX, you can be 2% of their fund or 4%, but not more, because it's a liquidity issue. And NASDAQ technically should have 3 to 4 times the liquidity that we have on TSX, which will allow the ETF to increase their allocation to AYA. Some long fund will increase their allocation to AYA. So we took a little bit of time because we needed to put our control systems in order to meet the requirement of NASDAQ. We are there now, and we're very, very pleased with this listing, because one fund, which I won't name, as soon as we announced that we were qualified, they bought like 4.5 million shares in the market because we were now a U.S. listed company.
We talk about your silver a lot. What about your gold production?
So the gold production will kick in 2029 when our second mine comes into production. Our gold production will be between 350,000 ounces up to 400,000 ounces per year. And that mine will also produce between 13 and 15 million ounces of silver. So that's going to kick in 2029. Right now, AYA is 100% a silver producer.
All right, Benoit Lassalle, President and CEO of AYA Gold and Silver. Sir, thanks for joining us today. Appreciate it.
Always a pleasure. Thank you so much.
Let's have a last look at the markets before the end of the trading day. They are in the green in the major North American markets, with the TSX up 0.6%, the S&P at 7,500, so up 0.75%, and the NASDAQ up as well. We're back with the end of day numbers in just a moment. Stay tuned. Here are the closing bells for the end of the trading day. At the NASDAQ today, Mobia Medical ringing the bell. In New York, it's the fire department for the city of New York doing the honors. And for the TSX in Toronto, CIBC Capital Markets, CDR is closing the day. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Markets are in the green today, with the TSX up another 226 points, or 0.7% on the day. The S&P also gaining today 57 points, up 0.8%. And the NASDAQ, a record close, up 232 points, up 0.9%. A record close for the S&P and the NASDAQ, beating the record closes of yesterday. Let's get to the movers in Toronto. Quebec ore is where we start. It's up 7.8%, or $4.49. That is on first quarter revenue, beating estimates for that company. The Boyd Group regaining after a drop yesterday on a first quarter miss. So the stock gained 6.4% today, $8.57, and taking the share price to $143.11. TFI International also on the move, gaining 6.7%, or $12.29 a share. Let's go to the other side, the flip side, in the red. Manulife down 5.7%, dropping his Q1 core earnings per share, missed the estimates. taking the share price down $3.12 a share. Stantec is where we go next. It is down today 6.6% or $7 and a penny per share to $99.91. And then Lithium Americas is also down 5.9% or 44 cents a share. Sprott Silver Sprott Inc. is down as well, $4.07 or $9.19, taking that share price to $187. And Silvercore Metal here down 4.8% or $1.03 to $20.49. All right, let's get some insight from Bloomberg's Jeff Morgan. He joins us now to talk about what's been going on. Jeff, Brookfield says it owns $2 billion worth of SpaceX before the official IPO. What is the math on that?
Yeah, the math on that, at least today, it translates into one of the top performing stocks in the S&P TSX Composite Index. It is up 5.5%, which makes it in one of the top 5 movers so far today. Not only did they report results earlier today with an expectation that they're going to merge with their insurance unit, kind of simplify their corporate structure, but this pre-IPO stake in SpaceX, which is a company that is targeting a valuation of about $2 trillion, is kind of overshadowing all of that. So Brookfield also committed $500 million to a developer of humanoid robotics called Figure. Investors very much rewarding what the company has has announced so far today. The headline does look like that big investment in SpaceX. Still waiting to see what SpaceX actually does when it comes to market. But $2 billion pre-IPO shares in that company.
Pretty much says that this company knows it's going to take off, no pun intended. Okay, let's get to Manulife because they missed estimates. What happened there?
Yeah, you're right. They missed estimates, and the stock is kind of getting clobbered. This is one of the worst performing stocks in the S&P TSX Composite today. So core earnings per share down a little bit below what Wall Street had expected. Earnings per share of $1.06. Estimate was $1.10. Total core earnings of $1.84 billion, and the estimate was $1.86. So these are not majorly off of what Wall Street had expected. There was a note out from Desjardins Securities saying that this is a slightly negative thing, but some of the impacts on those core earnings per share are not expected to persist forever. And so we didn't see a lot of downgrades, et cetera, but looks like analysts maybe a little bit more positive than what investors were, given just how sharply this stock sold off over the course of the day.
All right, Bloomberg, Jeff Morgan, we have to leave it there, but thanks for your time. I appreciate it.
Thank you.
Let's get to movers south of the border. Bloomberg's Avalon Purnell is joining us there. Avalon, Cisco, one of the big performers today on the S&P 500. What led to that?
Yes, Cisco jumped 13% today to end up at a record high. That's after reporting third quarter results that absolutely decimated expectations and also boosting its full year guidance. And part of that is also because they announced job cuts, because they are continuing to plan to invest further into AI. One thing that I found to be very interesting is that analysts were very bullish about the print. Morgan Stanley writing that Cisco's AI preparation is helping the company hit a growth rate that they have not achieved in more than 15 years. And their performance today made them one of the top gainers on the S&P 500 today.
Okay, let's get to REGENXBIO releasing some data for a treatment for a muscular disease. Can you tell us about that?
Absolutely. REGENXBIO did sink today, about 38% into the close, most intraday on record. And that's after the biotech reported that 2 patients had some severe side effects after taking their genetic therapy to treat a rare muscular disease. Part of that is a little bit interesting considering that the drug did meet its key goals. However, investors remain very skittish, especially since their key rival, Sarepta, faced a lot of similar concerns with its FDA-approved drug to treat the same disease, having similar liver problems that caused it to potentially get pulled off the market earlier. RBC is writing that while the data was largely in line with expectations, it may not necessarily meet the standard for an accelerated approval, which is a big deal for biotechs that want to be able to start to recoup some of those costs faster rather than slower.
Got it. Bloomberg's Avalon Purnell, thanks for the update. Appreciate it. Coming up next, as you saw, the U.S. market's closing at another record high, both for the Nasdaq and the S&P. We'll break that down a little bit more when we come back. New record closes today for the S&P 500 and the Nasdaq again. Our next guest notes that investors appear to be moving past the Iran war, focusing on earnings. Let's go to Carol Schleif. She's Chief Market Strategist at BMO Private Wealth. Thanks for joining us today.
Thanks for having me.
So I was looking at Ford, and shares were up double digits today because the company's making that pivot towards energy storage. Do you think we're going to see more of this movement as these more established countries try to gain momentum in the changing economy?
I definitely think you're seeing that. We saw Walmart, for example, move to NASDAQ, which tends to be a more tech, it's perceived as a more tech-heavy index, and to align itself more with that company, if you will, of the future as they're moving in and adapting to and absorbing new technologies. But we've got really broad spread earnings participation here, and I think that's what's helping underpin the markets as well, because many of these companies have paid a lot of attention to controlling those margins, and it's allowing for that magnification of drop through to the bottom line. And technology, especially AI and the move to all of the new technologies, are really give the potential to boost that bottom line.
Okay, so let's talk a little bit more about tech running away with earnings right now. What else sort of revealed to you? Was there a theme from the earnings results you've seen from these companies?
It has been very broad spread, which is very beneficial to look at. You had 8 different sectors of the S&P, for example, that had double-digit earnings growth. You had 8 different sectors with bottom line growth in double digits, and we're talking not just barely double digits. There were 3 or 4 that had 30 to 40% kinds of bottom line increases. So you're seeing it across the board in terms of participation. And the interesting thing is even with markets moving towards into all-time high territories, given where earnings have gone, the valuations are actually cheaper now than they were last year in aggregate.
You've mentioned something interesting, which is that a lack of access to that compute power could actually hold some companies back. Can you give me an example, or is there an example of that already?
A lack of, I'm sorry, can you repeat
You said
the
a lack
question?
of access to the compute power. It's going to obviously hold some people back. Some people are going to be able to get the access. Some aren't. How do you see that sort of working over the next year and a half?
It's definitely interesting because you've had this trend where everyone was focused initially a year or so ago on how much are companies going to spend on data centers and on AI. That now you've had a lot of machinations going through, not only on how much are people going to spend, but can you actually get them built, get them turned on, and get people access to it. I mean, even those of us trying to use AI on a daily basis are running up against you've used your token budget for the month in terms of doing that, or you've used your token budget until 3 o'clock this afternoon. And so there's those sorts of gating factors that are happening. And when they're happening on an individual level, you've got companies that are trying to access that as well. And actually, we're hearing some anecdotal evidence in terms of different companies being able to offer token budgets, if you will, to lure key talent from one place to another. It's yet another thing in the potential employment package.
Okay, so let's talk about the beneficiaries of AI. We talked about, obviously, the tech companies who have the memory chips are making a lot of money, but outside of straight tech, what are the industries or sectors you see that are already benefiting from the use?
Well, I think most industries are, especially those that can lean in. The interesting thing is there's a lot of experimentation, a lot of deployment going on a personal level. It's tougher to change corporate policies and rewrite and rethink corporate processes, especially in highly regulated industries. And yet companies are doing it. You're seeing a lot of adoption, if you will, in the legal community, in the banking and finance is experimenting with it a lot, or trying to figure out how to deploy. And theoretically, small and mid-sized companies should have a lead in being able to absorb some of this technology, particularly if they can get it in a pretty cost-efficient manner, number one. Number two, they're also key recipients to the extent that larger companies start trimming their workforces or letting attrition move people along. You can pick up high-quality engineers and programmers and things to help jumpstart some of that in some of these small and mid-sized companies. Then you've also got industries. You've got anything who's science-based, who's mathematics-based. You've got lots of experimentation that you're seeing in knowledge-heavy businesses where there's a lot of routine, sort of customer-centric, whether it's help center or things that can be automated. I know some of the phone companies are using them as really great backup when you go into a store to upgrade your phone and the tech has to call for support. A lot of times that support that they're hitting back in home office is an AI assistant these days.
We talked a little bit off the top about the fact that the market seemed to be shrugging off what's going on in Iran. Do you think they are not paying the proper attention to it? I'm wondering if you're looking at the fallout of energy prices at longer term.
Yeah, it's super interesting because if you'd said at the start of the year that we'd have another hot war, a major conflict going on, triple-digit oil, and inflation running the way it is, and said, oh, and by the way, markets will be at new highs when that's going on, people would have thought you were rather crazy. But I think markets in general really try hard to move beyond geopolitical risk, and even we've seen it time and time and time again as conflicts erupt, markets might react for a day or two and then really try to move on. And there's that piece of it, number one, that markets in general don't tend to hyper focus on geopolitical risk. Number two, specifically as it relates to energy and all of the other knock-on things that go, I think there is a general perception that in North America here, Canada and the US, we are better positioned now, both because of the makeup of our economies in terms of there's a lot more energy efficiency going on. Our cars are more efficient. Our energy grids are more efficient than they were in the 1970s, say, when we saw this before. So there's that suspicion. Plus, we're major producers. In the U.S., we're the largest producer of LNG. We're a substantial producer in Canada of all sorts of energy products. And so I think there's that presumption, too, in terms of it filtering through, that it will clearly be Southeast Asia and Europe that are more directly impacted by this. And you've seen it even while the price of flights, for example, is up, the U.S. is still a major producer of jet fuel or a major refiner of jet fuel. And so we're seeing less impact technically there. I talked to some farming friends yesterday, and they noted the fact that the fertilizer increases, they bought all their fertilizer. Most farmers pre-buy it, so they're pretty well done for this year, but it's next year if the prices stay up. And markets have a real tough time trying to discount what may or may not happen a year or two down the road, especially when there's something attractive like technology to focus on.
Gotta leave it there. Carol Schleif, appreciate your time.
Thank you.
When we come back, Mark Carney unveiled a clean energy plan. We'll dig into that in a moment. The Prime Minister unveiled a long-awaited clean energy strategy today, aiming to cut costs for Canadian households by up to 70%. Let's go to Rachel Doran. She's Executive Director of Clean Energy Canada, a think tank at Simon Fraser University. Thanks for joining us today.
Thank you so much for having me.
So we know that the grid needs to be modernized. That has been something on the plan for a long time, or part of the plan for a long time. But what do you think of this investment and this way of doing it?
So I think what was exciting about the announcement today, which is really just putting the kind of the backbone behind the strategy, was it was the first time we've really heard the government lean in and say electrification is the nation building project. This offers a transformative opportunity to transform affordability, energy security, and competitiveness, all while also meeting our climate goals, or the means in which to do so.
Why is that?
I mean, I think the government, what they laid out today was really saying we need to double our grid. And that's, a backbone of our economy in a way that's going to be attracting investment. But it wasn't just about what we need to build. It was also how that's going to transform people's lives. So the electrification, they've promised to try to electrify and retrofit 1 million Canadian homes, making sure those are electrified. That builds on the previous auto strategy where the government really put support behind the adoption of electric vehicles. And overall, trying to paint this picture of what we're seeing around the world, which is as kind of gas prices go up, countries are increasingly sort of backing away from the volatile nature of dependence on imported oil and gas and looking towards the low-cost potential of clean energy and renewables to fill that gap.
So regulations, of course, would be adjusted to allow for more natural gas use. What's your reaction to that part of it?
I mean, I think there's a rightful focus here on electrification overall, and what we need to do is build the grid to expand, to be able to power industry, to be able to power transportation. There's a lot of wins to be had by just making sure we have the right amount of electricity. What I think is missing here is a recognition of what's actually been happening around the world. Renewables are set to meet about 95% of global electricity demand growth between 2025 and 2027 because they are the cheapest available source of new electricity generation. So the strategy today said that they're going to be looking at revising the clean electricity regulations to allow for some more flexibility. And I think that that's reasonable. The concern is just they put a lot of focus up front on natural gas. And what we need to be doing is starting from renewables. They are so cheap these days that we need to figure out what we can do with them and work backwards to figure out how to fill the gaps. But I think overall, the strategy really addresses a lot of what we look to see in trying to make sure that Canada is doing what the rest of the world which is trying to build that path to electrification.
Okay, so you're saying basically that energy costs, which they're aiming to lower, which would be better served by going to renewables. But are renewables in a reliable way going to provide that energy?
Yeah, so to answer, first of all, why we're better served. So our research shows that Canadian households can save hundreds of dollars a month just by electrifying things like their homes and their cars. And that's because electricity, both in Canada, is more affordable and the prices stay more steady over time. As well, electricity is more efficient, so you just get more for the same amount of energy. So those are all kind of the underlying rationale why electrification can both be like a cost-effective tool as well as this kind of cleaner method of power. On the grid itself, I mean, I think we're not looking at a grid of the 1970s anymore, the way that we're talking about AI and smart technologies in other sectors. We're also talking about that on the grid. So renewables are going to play an important role, and they can be balanced by technologies like batteries. This strategy also laid out how they can be balanced even just by connecting the grids between different provinces and using, the hydro of BC to offset, renewable potential in Alberta. That's kind of its own, battery potential of sorts. And in addition, using new resources like smart grids just to kind of lower those peak amounts of electricity we'll need also helps produce a cost-effective build-out.
Can you
so
also
I think what the
give
strategy
me...
says, I'm going to save you money over time. It's both at the households as well as trying to just build out the grid in a cost-effective way.
Can you also give me sort of the bigger picture, which they talked about today, about provincial and territorial boundaries or things that don't cross over very well and trying to make that better connected?
Yeah, absolutely. So Canada, while we're one country, we don't actually have one electricity grid. We almost have 13 individual grids. And so the connections today are very limited in between provinces and electricity is in provincial jurisdiction. So I think the strategy tried to recognize this isn't something the federal government can impose on provinces. It needs to kind of come from the bottom up. But it really showed that the feds know they have a role to play, making sure that provinces can benefit equally and kind of strike a deal that's going to benefit everyone, that can make the difference in getting some of these projects over the finish line that have been stuck. Things like Atlantic Loop discussions, Alberta, BC transmission. We're looking forward to seeing some of those projects move forward.
All right. I do have to leave it there. Rachel Doran, thank you very much for your time. Rachel's Executive Director of Clean Energy Canada. Coming up next, Canadian specialty insurance provider Trisura Group expanding its presence in the U.S. More from the CEO when we come back. Toronto-based specialty insurance provider Trisura Group beat first quarter earnings last week. The company, which was spun off from Brookfield Asset Management about a decade ago, is expanding its footprint in the U.S. and also eyeing growth in Canada. Joining me to talk about that is David Clare. He's president and CEO of Trisura Group. Thanks for joining us today.
Thanks very much for having me.
Can you tell us a little bit more about specialty insurance and what that actually involves?
Yeah, it's a good question. Sometimes it's easier to talk about what specialty insurance isn't, especially for us. Most people, when they think about insurance, they think about home or auto policies or even life insurance. That's not what we do. Specialty commercial insurance for us means we underwrite tougher to price risks, risks that require maybe a bit more expertise to evaluate. Generally, that means we take a little bit more time to underwrite those risks, and there's a little bit more profit margin in those risks for us.
So the surety segment is what it's called, and that's your key driver.
That is. So surety for us means effectively supporting contractors who do work for governments around infrastructure. So if you're a contractor doing work on roads, bridges, schools, or hospitals, you need a partner like us to post a bond on your behalf to the government. We're about the fourth largest surety bond provider here in Canada.
Okay, so give me an example of who your competition would be in the space.
In this space, most of the large insurance companies that you would know participate, groups like Intact, groups like Aviva. It's a very large space that many significant P&C insurers have a part of their business that plays in. For us, the difference is really our main piece of the business.
To go a little bit off, and we'll get back to the main line in a moment, but I know that some companies are beginning to use AI for the underwriting services. Does that help you at all yet?
It's certainly something a lot of insurance companies are looking at. The area of our world where AI is going to be most useful is the really easy commoditized risk to underwrite. So today, that's not our part of the ecosystem. That being said, we have a number of proof of concepts across our business looking at ways to make that underwrite more efficient. I think it's going to be a partnership between those AI tools, I'll say, and the people that we have real expertise with. And it's one that's moving very quickly today.
Okay. What was key to your earnings this quarter?
I think it's been a good story since we spun out from Brookfield. A lot of that's been the expansion that we have into the U.S. If you look at our earnings, about 11% operating earnings growth, really driven by strength across the organization. So no one piece stood out. I think if we talk about where we've been putting a lot of effort in the last couple of years, it's been building our surety business in the U.S. So about 5 years ago, we launched a surety practice in the States, started from zero. Today, we're a top 30 surety provider in the U.S. The next piece of our evolution will be building out other pieces of our business in that American area as well.
So how many states do you operate in right now? I know California is not one of them, and that's a big state you probably want to get into.
You're absolutely right. So today we have about 45 states. We just recently added, in the first quarter, 5 new states in the U.S. California, which is one of the largest markets we don't have yet, but it's a really exciting evolution of the firm as we build out this capability infrastructure in the U.S.
The U.S. is obviously just a bigger market, so you want to focus there?
That's right. Our markets here in Canada are very mature. We're a very sophisticated player in those markets. I think a big opportunity for us is taking that expertise, that sophistication, and replicating it in larger geographies. If you think about the U.S., it's about 10 times the size of the Canadian marketplace. So a lot of opportunity for us to take really strong expertise of what we've done here, what we've done well, and build that in the U.S.
You mentioned quite often you take on the contractors who work on government jobs. There's a big plan for infrastructure build out by Ottawa over the next number of years. Will you get a piece of that?
I think this will be a positive for the entire surety industry if we see these types of initiatives moving forward. For us and for all the surety players in this space, this could be a really meaningful piece of the business to move forward. We're cheering the government on to build this.
Interest rates, how do they affect, or how much do they affect your business?
It can affect businesses in a lot of ways. For insurance companies like us, the most direct impact is obviously on the investment portfolio. So as we see interest rates move around, a big part of our portfolio is fixed income. What's interesting today, higher interest rates for us mean we can actually deploy or purchase securities in our portfolio that actually yield a little bit higher rates. So that movement that we're seeing today a little bit in the U.S. around inflation, it can be positive as we're deploying those bonds in that market.
Is there a metric that you're focused on for the next year?
Book value growth. So what we've seen over the past 5 years is about 20% annual compounding of book value. That means our balance sheet is getting bigger. We're at the largest size that we've ever been, about $950 million. If we continue growing that book value, the franchise value in the business keeps growing.
How hard is it to gain entrance into some of these markets. As you mentioned, in Canada, some of them are very established. I imagine the U.S. is the same.
That's right. I don't think there's any free lunch in our business. These lines of business that we compete in are all very competitive. It takes a lot of expertise to build a practice in these lines of business, but it's what we've been doing. We're now in about our 20th year in Canada. As I said, we're a top 4 player in this market. We're using that same roadmap to build out our practice in the U.S., and it is by no way easy. It's an execution story, but it's one we've got a lot of momentum on so far. So in 5 years in the U.S., we've built a practice now on a dollar basis, rivals our Canadian business in the U.S.
As you know, investors, when you talk to them, know Sun Life and they know Manulife. They know the big ones. What would you say to investors who would consider investing in your company?
I think for investors orienting themselves to Trisura, the most important thing to know is you may not heard of Trisura, you may not touch their products, but these parts of the business are incredibly valuable. Most insurance companies have specialty insurance practices that they're trying to grow. Specialty insurance is all that we do, and it's an area worth looking at.
So it's an area of expertise, and do you plan to go to other areas, or are you going to stay with just surety?
So we have other areas in the business today. We have surety, we have warranty products, we have corporate insurance, which is really insurance products for small businesses. There's a lot of our practice that spans many parts of the economy.
All right, I got to leave it there, David Clare. Thanks for joining us. Appreciate coming in.
Thank you.
David is president and CEO of Trisura Group. Up next, an AI chip maker raised $5.5 billion in the year's biggest IPO so far. More in a moment. Honda's decision to park its billion-dollar plan to build an electric vehicle complex in Ontario comes at a time when new EV sales have actually shifted into overdrive. March saw an increase of almost 75% from a year ago compared to gas-powered car sales, which are down. CTV's Adrian Gabriel looks at why there's a move back to electric vehicles in Canada.
An acceleration in electric vehicle sales is driving a surging trend across the country. This new Statistics Canada report has revealed that in March, there were more than 21,000 new zero-emission vehicle sales in Canada, a spike of more than 74% year over year.
They are in high demand. So is there a future for electrified vehicles? I mean, there's a present and a future for electrified vehicles.
And it's all Canadian. In February, the federal government announced a new 5-year EV incentives program, offering rebates of up to $5,000. Automotive insiders believe it's in part a driving factor.
The surge of gas prices and the return of the federal EV incentives is helping to drive those sales.
Another variable being cited, Canadian consumers becoming more familiar and open to the idea of going green.
We have consumers who have experience, their neighbors have experience with EVs, and they're trusting them.
New EV sales made up more than 12% of all vehicles sold in March, up from just over 6% during the same month last year. While Honda has indefinitely suspended its $15 billion electric vehicle complex in Ontario. In St. Thomas, Ontario, construction of a massive EV gigafactory battery plant is well underway, with production set for next year. Ottawa has also opened the door for 49,000 Chinese-built electric vehicles to enter the Canadian market. Demand from budget-conscious consumers is expected to be strong.
We're also hearing about exciting hybrids in the pipeline, and the variety of consumer choice is going to be building from all over the world.
One roadblock impeding EV growth, according to those watching the trends, is consumer anxiety over accessibility to functioning charging stations in communities across the country. Adrian Gabriel, CTV News, Toronto.
All right, for more on Honda's decision to suspend that EV build-out at the plant in Ontario, we were joined by Flavia Volpe, president of the Automotive Parts Manufacturers Association.
This is a company that is one of the most disciplined, if not the most disciplined investor in the global auto space, and one of the most committed investors in Ontario. Anytime there's been a crisis, 9/11, financial crisis, COVID, they've never laid anybody off. They never stiffed any suppliers. They stay solid. They've booked their first annual loss in their history. And that's because of the trade dynamics. That's the cost of moving cars into the U.S. and then cost of moving parts in and out, and what these tariffs have done to steel and aluminum costs for them. And then overlaid on that, look, 2 years ago, you and I talked about the biggest industrial investment in Canada's history and the biggest investment in Honda's history was going to lead the way for electrification. But the Trump administration changed that. They took away purchase incentives for EVs in the U.S. They took away production supports for supply chain, battery costs, and then they got rid of the EV mandates completely. Here, of course, we had similar ones. They needed to be adjusted, and they were. But he's taken the wind out of the market that plant was supposed to sell cars to, and increased the costs for the company that's supposed to make that investment to the point that, unfortunately, they had to make a really tough decision. But it doesn't change anything about their amazing ongoing investment in Alliston, Ontario. There's just, I think it's probably the biggest single industrial site by employee count in the country.
Now, I mean, in politics, people change, things can change. Is this dead forever, or do you think this is something they could bring back if the situation changes down in the States?
Well, the same CEO was talking last few days ago about the Chinese and the rate of product development in China and process development in China. And he's talking about an existential threat for his company and the industry in the Chinese market, and also acknowledging that threat is being exported to other markets here. So I don't know that this thing is going to be back on 3 months from now, 9 months from now, 18 months from now. The decision has been made because of the tariff environment and because of the no longer having the supports for the ramp up of the industry, the electrification. But that third hammer's coming, and it's China. And all of these companies, these legacy automakers, are going to be looking to conserve cash and to defend core markets. And neither one of those things is EV sales in the U.S.
And so what does that mean for the Chinese EVs that could be coming into Canada? Does that mean we'll see more of them, or is this going to, will their sales stagnate here probably as well?
No, I think, look, we heard the Magna CEO at an event this week talking about like priorities that countries need to pick. Do you want advanced manufacturing jobs? Is that your priority, or is affordability your priority? Because in the short term in automotive, those things don't reconcile with each other. And Canadians, if offered really cheap Chinese cars, regardless of why that cost is, and they're going to get 49,000 of them this year without the 100% tariff on them, and they'll buy them. We've seen that in Western Europe. We've seen that in Mexico and other markets that are very similar. What it means for companies like Honda and all the other market-driven players is we see just how difficult it is to make a go of it in electrification, even though it's the right thing to do, even though they're superior products. Why don't the Chinese have the same problem? Well, the Chinese are not worried about the first-time annual loss for a Honda. They've got 104 car makers that are in extreme competition with each other, and they're in their home markets, and so they're increasingly exporting that excess capacity. It's a completely different dynamic. Honda's news should be read out, or it's being read and analyzed at General Motors and Toyota and Ford and Stellantis and Renault and every other Western car maker around the world as another indication that either we're going to band together and figure this thing out, or we're all going to lose to the Chinese, who don't have Canadian content, who don't have American technology in them, who don't have French steel in them.
All right, and we're just about out of time, but I want to ask one last quick question. You're on the Prime Minister's Trade Advisory Council. What's the latest there?
Well, we continue to meet and share data points that are useful for the negotiating team. All of us are watching for USTR Ambassador Greer speaking to Congress, expected on June the 1st, where he's going to tell Congress what the Trump administration's intentions are with the USMCA review, renewal, et cetera. And we'll use those signals to help give careful insight networking and data points to the Canadian negotiating team.
Flavio Volpe is president of the Automotive Parts Manufacturers Association. We're going to take a quick break. Back in a moment. Canada, of course, has changed its immigration policy to allow less immigration for the country. Our next guest says the recent slowdown in jobs and GDP has more to do with the demographic shifts than any real economic weakness. Don Drummond is fellow in residence at the C.D. Howe Institute.
Well, we had 3 years of unbelievably strong population growth, almost all of it through immigration. Over 1 million people were coming in per year. Our population was growing at 3% per annum. That's triple the normal pace for a long time. Based on 350 to 400,000 immigrants, typically our population was growing about 1%, and then it exploded to 3%. We actually haven't seen anything like that in Canada before. We had 1 year, 1956, where we had a similar increase, and that was the exodus from Eastern Europe, particularly Hungary, but that only lasted for 1 year. So in 3 years, and then all of a sudden we go for over 1 million people coming in, and plus a reduction in the temporary foreign workers to this new target of 350 to 380. And we've seen now a couple of quarter release from Statistics Canada saying our population actually has been declining lately. So that affects everything. It affects our employment numbers, that affect our GDP numbers. And the reason we wrote this report is we keep reading the same commentary. It's weak, it's a deficiency of demand. And we said, no, it's largely coming from the change in demographics.
Mm-hmm. Yeah, so largely coming from that change. So let's talk about how much of the weakness is coming from that change versus economic weakness.
Well, we did this mathematical exercise and said if the labor market was operating normally, i.e. the unemployment rate stayed where it is, 6.9, which is the average it's been for the last 25 years, what would the demographics and productivity trends generate? And actually generates a decline in employment this year and next. Roughly 4,500 per month this year, 1,400 next year. So if by some coincidence you saw employment drop in a particular month by 4,500, that's what the demographics would give you. Now, of course, if demand is weak, it could be a worse outcome than that. And of course, if demand is stronger, it could be stronger outcome. But that's kind of your benchmark. And so when you see like the last month where employment fell by 18,000, that's somewhat larger than would be generated just from the demographics, but it's in the ballpark of that. It doesn't necessarily indicate that demand is deficient. We shouldn't be rushing out, oh, the Bank of Canada's got to stimulate because demand is sufficient. No, our capacity of the Canadian economy is growing very slowly at the moment.
And as you say, you wrote this report because that's what you kept hearing, right? Is that the softening labor market is a result of economic weakness rather than a byproduct of slowing immigration. What are the risks of that narrative, do you think?
Well, there's certainly a big risk on the policy front because you would interpret a modest change, either a small decline or a very small increase, somewhere in that vicinity as being a deficiency of demand. And of course, the knee-jerk reaction is, well, the Bank of Canada has to cut its rate to stimulate. Department of Finance should be stimulating fiscally. Of course, if you created an increase in demand at that point, you'd be bumping against that reduced capacity. And of course, that would be inflationary. So this is very reminiscent of the periods from 1973 to 1995. Hopefully it doesn't last for 22 years, where there was what turned out to be a permanent downshift in the rate of productivity, and the policy authorities either failed to recognize it or refused to accept it. And they kept interpreting it as a deficiency of demand. We got monetary stimulus that led to an outbreak of inflation, ultimately the Anti-Inflation Board, the 6 and 5 program. Mortgage rates went to 22%. Every year the fiscal authorities would stimulate it, and we ended up, thanks to that, to a fiscal crisis in 1995. I mean, we're a long way from that situation, but it has that same kind of feel. And I notice even in describing the March, the April outcome for the employment, some get it. There was some good analysis that pointed to the demographics, but others say, oh, this is just a weak month. We expect it to get stronger. And well, exactly why do you expect it to get stronger? You do realize our population is dropping, and due to aging of the population, the labor force is dropping even more. So why would employment get stronger?
Okay, so we've talked about the impacts on the labor market, and I know you touched on this, but maybe you can go into more detail about how Canada's reduction in immigration is impacting GDP growth.
Yeah, so that we somewhat different approach. Of course, to do the GDP, we have to bring in productivity, and it's a very simple assumption. Output per hour worked has averaged a 0.8 increase, so less than 1%, 0.8% since 2000. That's a pretty long term. That's a 25-year average. That's pretty robust. In fact, in the last 5 years has been weaker. So we could be more pessimistic. I'll return to that. But if we have the 0.8 and the labor market operates normally, then you would only get 0.5%, 0.5% growth in real GDP this year and next year. It would then go over to 1% for a few years, but it would settle at only 1.2% over the long term. And in the spring economic update, when finance did that long-term projection out to 2060, they used 1.5, and 1.2 versus 1.5 may not seem a big difference, but look at the level gap when you compound that all the way from 2026 out to 2060. It gives you a huge difference in the level. Now, again, demand could be stronger. Productivity could pick up, and that's what a lot of the forecasters, whether they realize it or not, and I think a lot of cases they don't realize what they're assuming, productivity would be stronger. But again, you ask yourself, why would it be? Why would it do better than the average of the last 25 years and a lot better than over the last 5 years?
Don Drummond is fellow in residence at the C.D. Howe Institute. Cerebras Systems shares surged at today trading debut, raising $5.5 billion U.S., largest IPO to date. Joining us with more on that is Bloomberg's managing editor of U.S. stocks, Michael Regan. Michael, can you tell us more first about it? And we talk about it as the largest IPO to date, but we know there are more coming down the line.
Yeah, I mean, obviously a huge IPO, as you say, the largest to date. I mean, we are waiting on SpaceX, which is going to be many multiples bigger than this, but this is still a huge IPO. And I think if you look at some of the demand metrics, it just shows you how much interest there is in these chip makers that are in the artificial intelligence space. Now, Cerberus it mainly intends to compete with the likes of NVIDIA, selling chips both to train AI models and then to be used in what's known as inference, or the sort of the operational phase of AI. Now, mind you, this is a company that only had about $500 million of revenue last year. After today, trading at a fully diluted market cap of something like 83 billion. So really a huge multiple on the stock, but it is a company that is posting very tremendous growth, something like 76% growth in sales last year. And again, trying to take on the likes of NVIDIA and the other big name chip companies out there. And just, 68%, almost 69%. Surge in the stock price. That alone, shows you how much interest there is. But really, those demand metrics, it had already increased the marketing range of this IPO earlier in the week, then priced it above that range, and again, 25 times oversubscribed. So really, just a tremendous amount of demand for this company going public today.
Let's take a step back and give viewers sort of the rundown as why it is such a good time to get into the space with the shortages we're seeing.
Yeah, right. I mean, there is just simply not enough chips being produced to satisfy this demand in the AI space, and this big, huge, massive capital expenditures we're seeing from the likes of Microsoft and Alphabet and Meta to build out these AI data centers. One thing that is not necessarily for this company, but for other chip stocks in the memory space, is this threatened supply disruption at Samsung in Korea due to a labor dispute that is really just throwing some fuel on the fire. And even President Trump's trip to China has people thinking bullishly, as if they could think more bullishly on these chip stocks. But Jensen Huang, the CEO of NVIDIA, tagging along on that trip, really signaling, how important the administration views this space, and potentially opening up the Chinese market a little bit more to NVIDIA and allowing that growth to cross borders. just remarkable bullishness towards the chip sector because of all this. Look at the Philadelphia Semiconductor Index. It's up almost 70% from the lows in March.
Yeah.
Some of those memory chip makers like Micron and SanDisk, triple-digit percentage gains already. So just a remarkable time in the chip stock space right now.
Michael Regan, got to leave it there. So thanks for your time. And thank you for joining us today on The Close. We'll see you back here tomorrow.